Saks Fifth Avenue has gone through some trauma lately, and this has not been a quiet struggle. It is actively fighting for survival. After more than a century as one of the most recognizable names in luxury retail, Saks Global is now preparing for what could be a Chapter 11 bankruptcy filing, following a year defined by missed payments, strained vendor relationships, leadership upheaval, and an increasingly fragile financial foundation. And this did not happen overnight. I'm Sammi Cohen, and this is Social Currency, a podcast that unpacks the stories that are shaping business, culture, and the intersection of the two. This episode is not about whether department stores are dead. That conversation has been happening for around 20 years, and frankly, that's not even a discussion at this point. This episode is about how Saks unraveled over the past 12 months, why the Neiman Marcus merger failed to stabilize the business, and why this moment matters far beyond Saks itself. I need to mention that this is very much an in-flight situation, so the details are still evolving. And I'm filming this episode now, and by the time that this episode releases, there may be a newer update, but I think it's still really important to talk about what the past 12 months have looked like for Saks and where they stand today. At the end of this episode, I want to share the single structural mistake that keeps repeating itself in legacy retail turnaround. Even though we're not exactly sure how the Saks situation will shake out, it's clear that the private equity team behind Saks has executed this playbook before many times, but we'll get to that part in a little bit. So let's start with the appearances. The Saks flagship on Fifth Avenue in New York has beautiful window displays during the holidays. The brand still carries some degree of cultural weight, although not the same cultural weight that it carried at one point. And to many shoppers in the US, shopping at Saks Fifth Avenue is a core nostalgic experience and memory. The Neiman Marcus acquisition was supposed to be the fix. In late 2024, Saks finalized a roughly $2.7 billion deal to acquire Neiman Marcus Group, creating a luxury retail powerhouse that included Saks Fifth Avenue, Neiman Marcus, and Bergdorf Goodman. Amazon and Salesforce took minority stakes as well. And the thesis here was that combining all of these players would unlock efficiencies, strengthen negotiating power with brands, and stabilize cash flow with minority investments from Amazon and Salesforce, adding that additional credibility to the vision. But the cost of that scale was very steep. The interest burden alone left Saks Global with very little margin for error, and when luxury demand softened and inventory issues mounted in 2025, the debt that made the merger possible quickly became the pressure point that pulled the entire business into crisis. On paper, the story sounded compelling. In reality, the deal was financed largely through $2.2 billion in junk bonds, high-interest debt layered onto a business that already operated on thin margins. S&P Global flagged this debt as unsustainable almost immediately. But the assumption here was that the scale would offset pressure, that combining purchasing power, logistics, and customer data would unlock some sort of efficiency that was going to move fast enough to service the debt. That assumption proved wrong. Luxury demand softened, inventory became harder to manage, cash flow tightened further. So instead of creating breathing room, the merger concentrated risk across three brands under one stressed balance sheet. So for all of 2025, Saks Global was defined by this cash stress. Earlier on in the year, Saks was already struggling to pay vendors on time. Some brands were waiting months, others were owed money that stretched back more than a year. And these weren't small delays. These were massive payments for these brands. And these are companies that rely on predictable wholesale payments to fund their materials, production, marketing, and future collections. Then came February of 2025. On Valentine's Day, Mark Metrick, then CEO of Saks Global, sent a letter to the vendors outlining a new payment plan. Saks would still pay what it owed, but not immediately. They would now have 90-day payment terms, and there would be an even more delayed installment plan for already overdue balances. For many brands, this was the moment that the mood shifted from concern to intense alarm. If you've lived through retail bankruptcies before and you've followed them, this language is very familiar. It's the language of a company that is buying time because they're on thin ice. Vendors were placed in an impossible position. Pull inventory and risk losing a critical distribution channel, or keep shipping and just hope that the retailer survives long enough to pay you back. And many brands chose to stay on. They believed that the Neiman Marcus merger would stabilize the business. They believed that Saks was too important, too iconic, and too embedded in luxury culture to fail. And that belief would be tested repeatedly. By July of 2025, Saks missed a 9-figure interest payment on its debt. That triggered a restructuring that moved certain bondholders higher up in the capital stack. In simpler terms, lenders secured priority over vendors if bankruptcy occurred. At that point, vendors weren't just worried about when they'd be paid, they were worried about whether they would be paid at all. And so by the fall of last year, the strain turned visible. Hilldun, which is a key factoring firm that backs shipments for roughly 140 brands that sell into Saks, stopped approving new inventory. So when a brand ships product to Saks, it usually doesn't get paid right away. That wait, as we've talked about, can be 60, 90, sometimes 120 days. Hilldun steps in and says, we'll pay the brand right now, and then we'll collect the money from Saks later. In other words, Hilldun fronts the cash so the brands can keep operating. It covers their payroll, fabric, orders, production, and more, while taking on the risk that Saks might pay late. And Hilldun alone supports around $500 million worth of annual product that flows into Saks stores. So when Hilldun stopped backing shipments to Saks, it wasn't a small admin issue. It was a signal that one of the biggest financial backstops in luxury retail no longer trusted Saks to pay its bills. And once that trust disappears, inventory stops flowing almost immediately. Brands began withholding inventory. Analysts had noted that Saks had an inadequate in-stock position. And in luxury retail, empty shelves are fatal. Shoppers expect newness, and if it's not there, they will leave. And some brands took an even more aggressive action when all of this started happening. Giovanni Fashion and many other companies actually filed lawsuits against Saks Global. By this point, Saks wasn't just losing vendor trust, it was losing control of everything. And once inventory dries up, no amount of marketing or brand equity can compensate. And now this brings us to the end of the year. With all of these money and vendor struggles, leadership had shifted. Mark Metrick stepped down as CEO. And for reference, Mark was a 3-decade veteran of Saks Fifth Avenue who was supposed to be the face of this hopeful turnaround. And Richard Baker, the architect of this Saks Global and Neiman Marcus deal, and the private equity force behind it all, stepped in. And this matters because Baker's background is not primarily retail operations. He is a retail real estate strategist. His career has been defined by acquiring, monetizing, and restructuring distressed retail assets. And at the end of December, Saks missed yet another interest payment of more than $100 million and began negotiating up to $1 billion in debtor-in-possession financing to keep operating through a potential Chapter 11 process. And Saks also began selling real estate, including the land beneath their Beverly Hills store. Selling land but not the building preserves short-term operations while giving up long-term leverage. These recent moves tell you exactly where the company is. It is now in survival mode. All of this brings us to where we are today. Department stores have been dying for decades, yet many survive longer than expected. They close stores, they downsize, they sell assets, and they renegotiate leases. They limp forward. What makes Saks different is how many of those levers have already been pulled, so there are fewer tools left. Of course, the luxury demand still exists. Wealthy consumers are still spending money, but the old department store model sitting between brands and consumers while carrying massive fixed costs and heavy debt no longer works at this scale. Luxury brands such as Louis Vuitton are building 350-foot-long ships in Shanghai that are part museum, part cafe, part retail shop. Luxury stores used to be the ultimate place to find curation, and to the dismay of many people, it doesn't look like these large physical locations are going to be the place where curation happens at that scale anymore. And lastly, I promised you that we would get to the playbook that Richard Baker, who is the chairman of Saks Global and the real estate scion behind it all, has used. Richard Baker has had this long history in retail, but let's get into the history because it's defined more by asset extraction than successful retail turnarounds. His most notable misstep was Lord & Taylor, which he acquired through Hudson's Bay Company with promises of revitalization. Instead of modernizing the business or fixing merchandising and operations, he focused heavily on monetizing Lord & Taylor's real estate, including selling its iconic Fifth Avenue flagship. The stores steadily deteriorated, brand relevance faded, and by 2020, Lord & Taylor filed for bankruptcy and was ultimately liquidated, ending a 194-year retail legacy. A similar pattern played out at Hudson's Bay Company, which was North America's oldest retailer. This is where Baker oversaw years of declining performance while extracting value from owned real estate. Rather than investing aggressively in store experience, inventory, or digital transformation, the strategy leaned on asset sales and financial restructuring to prop up the business. The result was prolonged decline, followed by the liquidation of Hudson's Bay's Canadian department store operations in 2025. For critics, these cases established a clear precedent. Baker knows how to unwind retail businesses and monetize assets, but his record shows far less success in rebuilding healthy, durable retail operations, which is why his leadership at Saks Global is viewed by many as a sign of restructuring rather than revival. So that was a lot. Where does this leave us today? We don't know exactly how the story will shake out. A bankruptcy filing could happen. It could be delayed. Assets could be sold. New investors could step in. But I want to share some of the top lessons that I'm taking away from this story. 1, scale does not fix a broken economic model. The Neiman Marcus deal amplified risk instead of resolving it. The business fundamentals were broken, and putting a ton of debt on the deal was a horrible move to begin with. Number 2, vendors are the silent lenders in retail. When payment trust breaks, the system collapses faster than most outsiders expect. Number 3, financial engineering cannot replace operational reality. Selling land and reshuffling debt buys time, not relevance. And here is the deepest lesson. Legacy retailers keep confusing asset value with business health. Real estate can mask problems for years. Debt can defer hard decisions, but eventually the model has to stand on its own. What happens next will matter not just for Saks, but for every brand, landlord, and investor that is still betting on scale as a substitute for strategy. And with that, that is a wrap for today's episode. I am back. It's me again. I needed to hop on quickly because I recorded this episode a few days ago before the latest update came through. So as of Wednesday, January 14th, it's now official that Saks Global has filed for Chapter 11 bankruptcy protection. So what has been widely expected is now confirmed, and the company is formally entering court-supervised restructuring. According to the filing, Saks has secured roughly $1.75 billion in financing to get through the bankruptcy process, including $1 billion in debtor and possession funding from a group of bondholders and additional credit from asset-based lenders. Leadership has shifted again, with former Neiman Marcus CEO, and I'm probably going to butcher his name right now, Jeffrey Van Romdonk. I think that's how you say it, or that's me guessing. And he was brought in to run the company through this restructuring process. And Saks says that the stores will remain open for now, but it's clear that the business will emerge much smaller, leaner, and far more constrained than it was before. And vendors, landlords, and creditors are now all going to be fighting over whatever value remains. So anyway, there is much more to be uncovered in this story, but I wanted to give you the latest and greatest. And I'll be covering more updates on this story on my Instagram. So now for real, thanks for listening, and I will see you next week. Thank you so much for listening to today's episode of Social Currency. I've been wanting to launch this show for so long. I can't tell you how excited I am to do this and how thrilled I am that you're actually here listening. It means the world to me. If you liked what you heard today, please rate and review the podcast because it massively helps to support the work I do to bring the show to life. And if you want to keep up with the hottest business lore in real time, follow me on Instagram at Sammi Cohen Talks and subscribe to my newsletter, Social Currency, which is linked in the show notes. Social Currency is a production of Social Currency Media and Money News Network. The podcast is hosted and executive produced by me, Sammi Cohen. Social Currency is produced by the Money News Network team. See you next time.